Can social networks be used to predict markets? Is there a way to extract the signal from the noise and use it to trade successfully? Hi, welcome to a presentation of Oraclum's unique methodological approach that tackles these very questions. My name is Vuk Vuković, I'm Oraclum's CEO, and I'll guide you through what we've done and how it works. Instead of doing these macro level long to medium term predictions, we at Oraclum asked ourselves, is it possible to make accurate weekly predictions based on social media sentiment and based on how people feel that the market might move or react to a certain event? Specifically, we wanted to apply our BASON survey to predict this weekly market volatility. We did it throughout a large part of 2021, and we are doing it for the entire year of 2022, after which we will round up the results and see where we are and how it works. So far, we've been very successful in the first 35 weeks of testing. Compared to the S&P 500, which in the same period would have given you a 2% return had you been consistently invested in the market, using the BASON approach, you would have gotten a 171% return on your portfolio. In fact, in 2022, ever since the start from January, our portfolio is up 28%, while the S&P is down 11% thus far. Whether it's a bull market or a bear market, the BASON seems to be making money. $10,000 invested in the BASON would have earned you $27,000 by now if you invested in May last year, and the same $10,000 in the S&P would have given you only $10,188. So there's a significant difference between our approach and just passive investment approach following the markets. More importantly, when you look at the correlation with the market after these first 35 weeks of testing, it's at a very low point of only 0.15, so only 15% correlation. So we were wrong basically only 6 times, and only once did the market make money while we lost money. That's in the fourth quadrant, as you can see. In these cases, we lost money and the market lost money. That happened 5 times, but in 29 times, so in 29 weeks out of the 35 weeks, we made money. In these cases, we made money and the market made money. And in these cases, the market lost money. 13 times the market lost money, and our methodology enabled us to predict that the market is going to go down in those weeks, and we made money. That's the point. Whether it's a bull market or it's a bear market, the BASON tends to consistently outperform. Okay, so what is it all about? What is the BASON anyway? I keep mentioning it. It's short for something called the Bayesian Adjusted Social Network Survey. I will exactly show you how we came to this idea, how it developed. But more importantly, it was a methodology that was tested already before in other events. So it was used to successfully predict Brexit and Trump in 2016 and Biden in 2020, some other electoral outcomes as well, in addition to a bunch of other outcomes, for example, related to COVID or consumer demand, etc. And in each cases, we exhibit incredible accuracy with our predictions. This is what encouraged us to try and apply the BASON survey to predicting markets, simply because the errors were very, very low, meaning that we could probably exploit a profitable strategy somewhere. So how does the BASON work? We ask our participants 3 basic questions. The first is to express your preference, so for example, for a product or a candidate, or an opinion of an issue, or in this case, in our last case, the price of a given asset. Then we ask, what do they think how other people feel about the same product or issue or candidate or price? And then, what do they think that how other people would answer the previous question? So this is a sort of a wisdom of crowds approach, where I don't ask you only what how you will react to a certain event or a candidate or pricing or idea of where the price of an asset is going to finish, but also what do other people think, everyone around you. So it's a wisdom of crowds concept. It's done through social media. So we've used, when we did elections, we used it mostly on Facebook, but now for markets, we're doing it via Twitter. And these are the type of the example questions from our first big successful survey, or second, sorry. The first was Brexit, the one between Clinton and Trump. So you can see, for example, a question of what percentage of the population of Pennsylvania do you predict will vote for each of the candidates, and then you have a slider where you adjust. For example, this is this is the typical wisdom of crowds question, and then the second one. The adapted wisdom of crowds question is, how do you believe that others in Pennsylvania will respond to this previous question? And when people get these questions after answering the first two, the first one, which asks you, who are you going to vote for? When they come to these questions, they tend to self-correct. So they tend to put themselves in other people's shoes, and they start thinking, and this thinking process, whether it's a 30-second or a 60-second process, immediately makes your prediction slightly better. And this is an approach that was developed much earlier by behavioral economists, behavioral psychologists like Daniel Kahneman and Amos Tversky, who were looking at ways of trying to prime people to get a better response, a more accurate response. So if you ask someone to intuitively give you an answer, their intuitive answer may not be enough, but if you give them a moment to think about it, if you encourage them to think about it for 30 seconds or 60 seconds, you get a much better response. This is why our questions are deliberately convoluted. They're not simple. You need to think about them. You need to think about what you're predicting, and therefore you, by correcting your own bias, your own prior beliefs, you get a much more precise posterior belief. So that's hence the Bayesian element. So you have a prior belief about something. I give you a question that's gonna encourage you to think about the issue, and then you'll formulate a posterior probability that's different than your prior. Okay, but enough about the technical aspects of it. So this is only the first part, all right? So part one of why the BASON works. The most important part, the most interesting part, is the uncovering of the bubbles. So when we ask you a question within our survey, we essentially try to capture also your network of friends, so people you hang out with. Only, however, if they also get into the survey and answer the question. So we cannot know who your friends are either voting for or what they think about a certain asset price or whatever, unless they also come into the survey, your friends on Facebook or followers on Twitter. So, which is why we encourage this social network sharing, so that we can capture networks of people. And this gives us a unique approach in figuring out the clusters that people hang out in, or formulate amongst themselves. So, for example, this is the first election that we did back in 2015. It was for a multi-party election, and every circle is one individual. So this is a network of 6,000 individuals. The size of the circle is, we can call it an influencer, so a person that gets about 200 others into the survey. In this case, this was a person that got 200 others. Some of them got less, so their circles are their size is lower. And the color is the party that you're voting for. Notice the yellow cluster down here. So this yellow cluster is a typical example of a bubble, a cognitive bubble. So these people only hang out with each other. They only exchange information with each other. So when they enter the survey, when asked about what their party is going to get on the election, they say 40-50%, which is unrealistic. Their party is a fringe party that got about 4% of the vote on those elections. So when they come in and give me a prediction, they're not lying. They're simply looking at only one version of reality, their own, okay, and shared among their friends. Similar is this cluster, this red cluster or this green cluster over here. What we want people from heterogeneous groups. So in terms of elections, which is the easiest explanation, some of your friends are left-wing, some of them are right-wing, some of them are centrists. So this gives you a higher probability of being right. It doesn't necessarily mean that every one of these people will be correct, but it gives them a higher probability. Unlike these individuals over here. So they have a very low probability of being right, whereas people in this cluster have a very high probability of being right. So notice that, for example, the yellow cluster, these party voters, all of them which are here, they get a very low weight in their response, assigned to their response, while as, for example, these yellow dots over here, so these individuals, even though they're voting for the same party, but they have a much better perspective on how their party is going to go through. So when these people give predictions, they say that this party is going to get 4%, even though they're voting for it. So their bias is lower. That's the point. If you apply the same thing for markets, so you're not going to have multi-parties, but you're going to have, let's say, two basic outcomes. Either they're going up or they're going down. And what we can see is that in such groups, the bears and the bulls, for example, those who are permanently bullish or permanently bearish, tend to cancel each other out, and you get a prevailing sort of bias of where the market is going to end up in that week specifically. Now, a cool feature of this approach is that when we use a network analysis to balance the sample, based on the wisdom of crowd questions that I just shown you before, you no longer have the necessity to entertain a representative sample. So this means essentially that, for example, this network that you see before you is a network of urban, young, and well-educated voters. And usually, if I just ask them who they're going to vote for, you will see a very strong bias towards center-left parties, for example. However, because of the way we're asking our questions and because of the network methodology that eliminates the bias in their responses, we're able to get a very accurate prediction even for the right-wing parties where we didn't have a lot of their voters in the sample. The same thing works for predicting events, predicting product demand, or as we've just shown you in the beginning of the presentation, for predicting markets. So I cancel out the homogeneous groups, the groups that are clusters, that are bubbles. They tend to cancel each other out. They tend to be they get very low weights. And I'm looking for heterogeneous groups, people that live in heterogeneous groups that have an idea of both sides of the argument or several sides of the argument. And even though they might not be perfectly accurate every time, they have a much higher probability than the people in clustered bubbles. That's essentially the idea of this approach. In terms of some of our results, so I mentioned the Trump-Clinton election back in 2016, the Brexit as well. You can see that we did in fact predict Trump winning that election despite every single poll pointing out otherwise. And this is just to show you the results for the key swing states for Pennsylvania, Florida, North Carolina, and almost all of these. The accuracy of the approach was within a single percentage point margin of error. Same thing for Brexit. So we estimated 51.3% for leave. The actual outcome was 59.1%. The same thing happened in 2020, where we did this commercially for the first time. We had a bunch of clients where we were sending information about there being very little chance of a blue wave, saying that both Florida and Ohio are going to go to Trump, even though these were borderline states at the time. And we correctly called Michigan, Wisconsin, and Pennsylvania the three key swing states in that election in favor of Biden. However, we were saying it's going to be much closer than what the rest of the pollsters were predicting. So our electoral college estimate was about 294 electoral college votes for Biden, whereas the pollsters were giving him between 340 and 350. Just to showcase the errors, so our prediction for Pennsylvania and Wisconsin versus the final outcome, we're talking about a 1% average error across all these key swing states. A little bit higher in our case for Florida and Ohio, but still calling it in the right direction for Trump. Whereas the polling average across all of these states, they were giving it to Biden. Their errors much bigger, 4 to 5% and 7% in this case. The reason is simply because regular surveys depend on having a representative sample, which is almost impossible to get in a modern day setting, whereas we do not, and we have the unique network methodology that enables us to move past that. Now, so explaining how does it work doesn't answer the question of why does it work. Now, there's a lot of hypotheses here, and we've been following a lot of behavioral psychology and behavioral economics in formulating the methodology, in addition, of course, to our knowledge in network theory and network analysis. However, there's an interesting explanation that can be used from on one hand, John Maynard Keynes, who in the General Theory of Employment, Interest, and Money talks about when people deciding to make investments, they're basing their decisions on observations of what others are thinking. There's an interesting story here about a beauty contest that Keynes was engaged in for, I think, Reader's Digest or someone else. So they had a contest where each week or month, I don't know, I think each week, they were giving pictures of women, and the readers were supposed to vote for which one is going to win the competition. And if you guessed it correctly, if you vote for the person who won, you have a chance of winning a prize. The point of the competition was, no matter how sexist this might sound from today's perspective, but the point of the competition was not to vote for the person who you feel is the prettiest, but for the person who you think that other people will think is the prettiest. Okay, so it's not about your preference, it's about thinking what society or your neighbors or people that you're surrounded with, who they think is going to be the prettiest, and therefore win the contest. Robert Shiller writes a lot about this in his excellent new book, Narrative Economics. I recommend it, talking about how we often think about what others are thinking about their individual perspectives, and this is how most bubbles are formed. He does a lot of research about market bubbles, stock market bubbles, and it can explain a lot of outcomes in economics about how people looking at what their neighbors do, looking at what their friends do, and how this affects their own decisions and how this can drive economic outcomes. So we're trying to take a small part of that approach and applying it to our own methodological way of thinking about markets and how they can be predicted. Another interesting theory is reflexivity from Soros. Again, I think I already mentioned this when I showed you the network graph. So thinking about perma bulls and perma bears canceling each other out, the homogeneous bubbles, and what's left is the prevailing bias that can essentially show you at which direction the market is gonna go for the week. So the BASON can also be used in figuring out the weekly signal, essentially, of this prevailing bias. We're not using it in this particular case for the underlying trend of the stock price, of what Soros writes about as well in his theory, but we're using it to figure out the weekly signal. So the way this is being organized is that we run a competition each week through a survey that opens each Tuesday at 8 a.m. Eastern Time and lasts for a total of 24 hours, so Wednesday the next day, 8 a.m. the next day. And we're predicting 5 indicators, 2 stock market indices, S&P 500 and the Dow Jones Industrial, predicting Bitcoin, the 10-year Treasury yield, the VIX, which is the measure of weekly volatility. It's inversely correlated with the S&P 500, and also 2 stocks, Apple and Tesla. Why these 2 stocks? Simply because they have the biggest volume of trades out of all stocks, out of most stocks on the market daily. So we're trying to see if these predictions can be good enough so that we can capture some value from them in terms of trading these particular stocks or indices. We also offer monetary prizes. So each quarter, one person gets a $2,000 cash prize. So this is actual cash. It's not tokens or cryptocurrency. So we're talking about $2,000 in cash. And we run weekly leaderboards where people can compare with each other. And this is sort of a gamified approach where users are engaged in these predictions. They can earn money, and also everyone who's engaged in the competition and leaves their email, they get our predictions each Wednesday mornings, as soon as we make them, as soon as the survey is closed, we make the predictions and we send it to our survey users, and that way we can get they can also get an additional benefit, not just participation in the competition and a potential prize, but you can also trade weekly using our signals. In terms of skin in the game, so this is the graph that I showed you at the beginning of the presentation. So we actually do put real money, our own money. We started with a $10,000 portfolio where we took 2,000 and we take only 2,000 each week. So risking initially that was 20%. Now it's much less, obviously, but we only risk $2,000 of the $10,000 portfolio to adapt an option strategy that can ensure that we make money if our prediction is correct. Specifically, we use the SPY Iron Condor. There's a bunch of other option strategies that are available, the Iron Butterfly, for example, but we decided to go with the Condor. So it has a limited loss. So for example, this is what it looks like. So if our price target for a stock is $500 and our confidence interval, so we deliver, every time we deliver a prediction, we give you the confidence intervals for each price target. So let's say the price target is 500 and the confidence intervals are between 450 and 550. So we're gonna buy a put option and a call option with the with some levels within within the confidence intervals, and we're gonna sell a put option and a call option again within these intervals. So if the price of the stock or index finishes within these two price levels, we make money on our predictions, meaning, and this is usually the confidence intervals for SPY. So this is the ETF that follows the S&P 500, is usually within 2% of the price target. So in this case, it wouldn't be 550 and 450, it would be much less. So we need to be really accurate in order to make money every week. If we're wrong for any given week, then we lose money. However, we do have stop losses so that these losses do not become too big. But thus far, we only lost money, as I shown you, 6 times. We earned money 29 times. So the compounded gains week in, week out make sure that our portfolio outperformed the S&P by such a high margin. Thank you very much for paying attention. This is how the BASON methodology works. I hope you had an engaging and interesting time. I'm open to all questions that you can leave in the comment sections, and I invite you here to subscribe to our Substack newsletter. The link is going to be in the below the video, and follow our weekly market predictions. Engage in the competition. If you're good enough, you can win the prizes, and also feel free to benefit from our weekly signals on price movements. Thank you very much for paying attention, and goodbye.